Investing in ETFs can feel like navigating a maze. There are countless options, endless charts, and a ton of financial jargon. But here's the deal. You don't need 50 different funds to build a successful portfolio. What if you could narrow it down to just 6 ETFs that offer both growth potential and safety for 2025? The clock is ticking, markets are shifting, and these picks might be your ticket to staying ahead of the curve. Stick around because I'm breaking down 6 ETFs you'll want to seriously consider before the year ends. Investing in 2025 is going to be different. Markets are evolving, new trends are emerging, and the need for a strong, diversified portfolio has never been more important. In this video, I'll walk you through 6 ETFs that have been carefully selected based on growth potential, stability, and their ability to adapt to future trends. Whether you're looking to maximize returns, hedge against risk, or simply simplify your investment strategy, these ETFs have something for everyone. And don't worry, I've done all the research to ensure these picks are not just random names, but strategic choices backed by data. So, grab a notebook, because by the end of this video, you'll have 6 ETFs to consider adding to your portfolio to make 2025 your most profitable year yet. What if I told you there's a way to gain exposure to some of the world's most successful and innovative companies? That's exactly what a tech-focused ETF like QQQ, the Invesco QQQ Trust, offers. This ETF tracks the NASDAQ 100 index, giving you access to 100 of the largest non-financial companies listed on the NASDAQ. Its portfolio includes household names like Apple, Microsoft, Amazon, and Nvidia, giants that are leaders in their respective industries. These companies drive technological innovation and have consistently delivered strong growth over the years. Why does this matter for 2025? Because technology is not just a trend, it's the backbone of our modern economy. From cloud computing to e-commerce and artificial intelligence, the sectors represented in QQQ are shaping how businesses and consumers interact. By investing in QQQ, you're aligning with established leaders poised to benefit from ongoing advancements. But here's the kicker. While QQQ offers stability compared to more niche tech ETFs, it's still concentrated in the technology sector, which can experience higher volatility during market downturns. That's why balancing it with a diversified portfolio is essential for long-term success. Serious about investing? Then you need the right tools. TradingView gives you advanced charts, price alerts, and real-time data, all in one place. Whether you're tracking ETFs, stocks, or crypto, stay ahead of the game. Check the link in the description. Imagine being part of a global shift toward cleaner energy, where governments and corporations are pouring billions into renewable resources. That's exactly what makes the iShares Global Clean Energy ETF, or ICLN, a standout choice for 2025. This ETF focuses on companies in the renewable energy space, including solar, wind, and energy storage. Its holdings feature big names like NextEra Energy and Enphase Energy, which are leading the charge in transitioning the world away from fossil fuels. With global clean energy investments expected to top $2 trillion in 2025 alone, this sector is on a trajectory for massive growth. Here's why this ETF matters now. As countries commit to achieving net zero emissions, demand for clean energy solutions will skyrocket. Think about it. Electric vehicles need charging stations, grids need upgrading, and businesses are under pressure to reduce their carbon footprints. But like all investments, there's a balance. Renewable energy stocks can be volatile, especially with fluctuating government policies. The key is patience. ICLN is a long-term investment that aligns with the future of energy. If you're ready to invest in the green revolution, ICLN is your ticket. What if you could invest in a fund that not only grows over time, but also pays you while you wait? That's the appeal of SCHD, the Schwab US Dividend Equity ETF. This ETF focuses on companies with a history of consistent and growing dividend payments, offering both stability and income. SCHD's portfolio is built around financially strong companies like PepsiCo, Johnson & Johnson, and Home Depot. These aren't just blue-chip names. They're businesses with proven track records of weathering market downturns and rewarding their investors. Here's what makes SCHD a great pick for 2025. While growth stocks often steal the spotlight, dividend-paying stocks provide a cushion during volatile times. Dividends can be reinvested to compound returns or used as passive income, which is especially valuable in uncertain markets. Another bonus? SCHD has one of the lowest expense ratios among dividend ETFs, meaning more of your money stays in your portfolio, working for you. If you're looking for a mix of growth and reliability, SCHD offers a well-balanced approach to building wealth over the long term. Imagine investing in countries where economies are growing faster than most developed nations. That's the opportunity offered by the iShares MSCI Emerging Markets ETF, or EEM. This ETF provides exposure to markets like China, India, Brazil, and South Korea, which are experiencing rapid industrialization and expanding consumer bases. EEM includes companies such as Alibaba, Tencent, and Samsung, businesses that are dominating their regions and innovating globally. With rising populations and an increasing middle class, these markets are expected to drive significant economic growth over the next decade. Why is this important for 2025? As developed markets face slower growth and aging populations, emerging markets present a compelling alternative. For instance, India's GDP is projected to grow at over 6% annually, far outpacing many Western countries. This ETF allows you to capitalize on these opportunities without needing to handpick individual stocks. But with high growth comes higher risk. Emerging markets can be more volatile due to political instability, currency fluctuations, and regulatory changes. That's why EEM works best as part of a diversified portfolio, balancing its potential with more stable investments. If you're ready to take advantage of the next global growth wave, EEM is a strong contender. Want to invest globally without losing money on currency conversion? Wise gives you the real exchange rate with low fees, so more of your money goes into investments. Sign up today. Link in the description. When it comes to industries that never go out of demand, healthcare tops the list. That's why the Healthcare Select Sector SPDR Fund, or XLV, is an essential consideration for 2025. This ETF is designed to give you exposure to the biggest players in the healthcare sector, including companies like United Health Group, Pfizer, and Johnson & Johnson. Healthcare is one of the most resilient sectors, largely immune to economic downturns. People will always need medical services, treatments, and innovations in biotech. With an aging global population and advances in medical technology, this industry is positioned for steady growth in the years ahead. What sets XLV apart is its balance between stability and growth. On one hand, you have established pharmaceutical giants with consistent revenue streams. On the other, it includes biotech firms driving groundbreaking research in areas like gene editing and immunotherapy. For 2025, this ETF is a smart play for investors looking to add a defensive yet growth-oriented asset to their portfolio. It offers the reliability of healthcare alongside the potential for cutting-edge innovation. Real estate has always been a cornerstone of wealth building, and with the Vanguard Real Estate ETF, or VNQ, you can tap into this asset class without owning physical property. VNQ invests in real estate investment trusts, REITs, which are companies that own and operate income-producing properties like office buildings, malls, and apartments. What makes VNQ a great option for 2025? For one, real estate continues to be a reliable source of income through dividends. REITs are required to distribute 90% of their taxable income to shareholders, making them an excellent choice for generating cash flow. Additionally, VNQ provides diversification. Real estate often behaves differently from stocks and bonds, offering stability when traditional markets are volatile. With inflation concerns still lingering, real estate serves as a hedge, as property values and rents typically rise alongside inflation. VNQ's holdings include major players like Prologis, which focuses on logistics properties, and American Tower, a leader in telecom infrastructure. These companies are aligned with long-term trends, from e-commerce growth to the expansion of 5G networks. If you're looking for an asset that delivers steady income and diversification, VNQ is a smart addition to your portfolio. Now that you know the 6 best ETFs for 2025, the next big question is, how do you build a balanced portfolio with them? The key is diversification, spreading your investments across sectors and asset classes to reduce risk while maximizing potential returns. Here's a step-by-step guide to doing just that. First, consider your goals and risk tolerance. Are you looking for aggressive growth, steady income, or a mix of both? Your answer will determine how much weight you assign to each ETF. For example, if you're younger with a higher risk tolerance, you might allocate more to growth-oriented ETFs like QQQ and EEM. If you're closer to retirement or prefer stability, SCHD and VNQ might take up a larger share. Let's break this down with a sample allocation. 30% to QQQ, tech-focused growth ETF, offers exposure to innovative, high-growth companies like Apple, Microsoft, and NVIDIA. While it carries higher risk, it has significant upside potential if the tech sector thrives. 20% to SCHD, Dividend Growth ETF, provides stability and consistent income through dividend-paying companies, acting as a buffer during market volatility. 20% to XLV, Healthcare ETF, combines defensive stability with growth potential, leveraging the resilience and innovation of the healthcare sector. 15% to ICLN, Clean Energy ETF, taps into the expanding renewable energy sector, striking a balance between growth opportunities and sustainability. 10% to EEM, Emerging Markets ETF, adds international diversification by investing in rapidly growing economies outside the US. 5% to VNQ, Real Estate, diversifies your portfolio further, offering steady income streams through real estate investments. Adjust these percentages based on your personal preferences. The idea is to create a portfolio that balances growth, income, and risk. Finally, remember to rebalance your portfolio regularly. As markets fluctuate, some ETFs will grow faster than others, potentially throwing off your allocation. By rebalancing once or twice a year, you'll ensure your portfolio stays aligned with your financial goals. With these 6 ETFs, you're not just investing in individual sectors, you're building a strategy designed to weather market changes and grow over the long term. If you found this video helpful, make sure to check out my other videos on the best Schwab ETFs and the best Fidelity ETFs to explore even more great options for your portfolio. Don't forget to hit the subscribe button for more investment tips and leave a comment below sharing which ETF you're most excited about for 2025.